Welcome back to the Real Estate 401k Show. I'm your host, Mike Weinstein, alongside Justin Frederick and Ryan Gerdes. I don't even know what text word or what code to have them text.
Let's do FANNIE.
FANNIE? Okay.
Spell it any way you want.
So you could even spell it ASS. I don't care.
Yeah, there you go. That's actually good. Let's go with that. Let's go with text ass.
623 AZ RECON. All right. So just to start this off, the intention of this episode is not to dive into politics. We don't care whether you're a fan of Trump or you're anti-Trump. This is not what this episode is about. But decisions.
I love how PC you try to get.
I try to.
I mean, he's PC when it comes to the disclaimer, but then when it comes to actually talking, he's the least PC person I know.
Text the word ass to 623 AZ RECON or Justin, same thing.
Yeah. Thanks, Mike.
But there are decisions being made by this administration that do, for good or for worse, doesn't matter what side of the aisle you're on, but for good or for worse, do impact buyers and the process for people buying real estate in the United States of America. So one of the most recent announcements was, in essence, defunding the CFPB. So, Justin, what is the CFPB?
It's the Consumer Financial Protection Bureau. And basically, they look over all financial institutions. So they put regulation on financial institutions. Basically, they came about because there was no regulation on mortgage lending in 2008, and they were created to regulate the mortgage lenders of America.
Now, the first thing I thought of when this announcement was made is, as real estate professionals, are kickbacks back in?
You see what I'm talking about?
Yeah,
PC stuff way across the line. You just jumped the line.
Good job, Mike.
Yeah,
you evil Knievel the line.
Oh boy. So I want to get into three of the biggest impacts in the sense of the three things that the CFPB have done and specifically from the CFPB, but how they're impacting buyers and the decisions that they made. And one of them, we'll start off with, really made it a lot easier for home buyers when it came down to student loan debt.
So, they've done a lot of things. So these are more some of the most recent, so it's easier to kind of talk about it. But student loan debt, when we're running what's called automated underwriting systems, and that's trying to get an automated approval on a file, and it lays things out for us. When you have a lot of liabilities, it considers those risk factors. And a lot of people have a ton of student loan liabilities because they don't just give you one student loan when you're going to school. They give you one student loan for a semester. And sometimes they're giving you multiple student loans for a semester. So in some of these cases, I feel like I've seen over 100 student loans on somebody's credit report. And so that's a big risk factor. Mm-hmm. It used to be when it comes down to running that automated underwriting system. But the CFPB was a big proponent into making sure that we weren't getting denials based on student loans. And the reason that they jumped into it was they were finding out that the individuals that held student loans seemed to be less risky borrowers. So they showed the proof and they laid it out to Fannie and Freddie, and we were able to get rid of that risk factor by the labeling of the student loan.
So was that on the underwriting side, or was that how they actually established, or was it like an establishment through FICO with TransUnion, Equifax, Experian? Like,
They're already labeled through TransUnion, Equifax, and Experian. What happens is that credit report goes through the automated underwriting system, and so it's it's basically analyzing that credit report as it goes through and the amount of liabilities, what the liabilities are, and how it's looked at it. And so basically, they updated the systems to not show it as a risk factor.
Got it.
Yeah.
And so you said, and who knows when this thing airs, the status of the CFPB. But at this point, when we're on air right now, the CFPB has pretty much just been defunded by
Trump.
Doge or Trump or what do you want to say? These things that we're discussing, it's not like they're going to take these away. What we're trying to do is just highlight some of the benefits and some of the things that this agency has done for buyers. Correct?
Correct. And they were a huge part of putting together TRID, which had us do loan estimates, closing disclosures, giving time periods to borrowers to be able to review that, so they weren't forced into a loan, and they had some time to make changes.
Right, because before they could get disclosures the day before that they were supposed to close, and then they felt like their back was against the wall.
100%.
Like, okay, I if I want to close on this thing, I have to accept these terms, or we have to start back at from square one. And so that's what that was for, right?
Correct,
Okay.
correct. It requires us all to use these same specific documents, so you're not getting different documents from each different lender. You're able to read them, and these documents show how to read the document. So it really helps the consumer. If you really want to dig into it, we all have the same document. It lays out the fees based on who you are as a lender, and the title companies, everything involved in the transaction. It was really a nice generalized document to go across the board.
All right, so one of the other positive byproducts from the CFPB, especially when it comes down to qualifying as a home buyer, had to come down to medical bills, because we, in the past, a $30 medical bill that you weren't aware existed,
Or collection, right?
That was in collections that
collection.
could keep you from owning a home.
I've seen a $30 medical collection take somebody's credit score down over 100 points. So when we got it deleted, it immediately rose their score that much. Now, they were huge, and they got this taken care of. Basically, now medical they've made it against the law to have medical on your credit report, which that's a big deal.
It's a huge
It's
deal.
a big
I
deal.
mean, don't you think that the medical community is going to come back to?
I feel like something's going to
haunt
happen
this?
because they got to get paid.
Right.
And if they don't get paid, who's going to pay for it? Taxpayers.
Right.
At the end of the day, they're going to write it off as a loss. And so these companies won't be collecting income, and they'll be showing losses, so they won't be paying taxes. So at the end of the day, it's going to come down to consumers. However, I do feel like something's got to give there, and I feel like obviously I'm biased when it comes to this, but I feel like this was a good move, because there's a lot of people. I've done quite a few cancer survivors loans, and you wouldn't believe the amount of medical debt that has just absolutely destroyed them, and they have no shot. They're not going to be able to pay them or get them deleted or anything like that. So this was a big deal.
All right, if you'd like some more information about the lending process and the impact of the CFPB news or just strategies in building wealth in real estate, go ahead and text the word FANNIE to 623 AZ RECON. That's FANNIE to 623 AZ RECON. Okay, so we talked about student loans. We talked about medical bills, and then one of the other positives that we've seen as a result of the CFPB for home buyers is when it comes down to your credit report and risk factors. Explain that to us.
So they've been very active on making sure that we're getting more home buyers into homes that have less risk factors, and basically they're just showing information on funded loans compared to defaults. So one of the biggest things was first-time home buyers. As a first-time home buyer, that was showing a risk on credit, being that you've never owned a home. So they're expecting to have more defaults, and that's fair enough. But what the research has shown is actually first-time homebuyers aren't as risky as they thought they would be. So they helped us with the automated underwriting system on making it easier for first-time homebuyers to qualify. And getting those automated approvals is a big deal because you can go higher in your debt to income ratios. It's you don't have to have the reserves that you need to do what's called a manual underwrite, and basically you're manually underwriting it. And those guidelines require a lower debt to income ratio. And in a lot of cases right now with that lower ratio, you can't qualify for a house because you need those extra percentage points in order to get to those minimum purchase prices that are available out there to qualify. So this was a big deal. Along with the first time homebuyer program, it really helps out.
So I'm going to play devil's advocate here because
Shocker.
can we can agree that these things at first blush are a positive thing, right?
No, 100%.
But if you're a first-time home buyer and you've never gone through either the process of buying a property or you've never had that type of debt, that it's kind of a sticker shock for a lot of people. If they're fresh out of college or they're younger, then they're going to be a first-time home buyer, and they're going to go from paying whatever $500-600 a month in rent because they're renting an apartment with a buddy. Now all of a sudden they have a $3,000 mortgage payment that we've been able to exercise a lot of these methods, using the AU, using the medical, etc. And so now we've just put them in a position where their payment might be a little bit higher than they could actually afford.
So it shouldn't be, and it's based on the calculations of just a standard a purchase. And we're not going above and beyond what a normal person could purchase a home with.
But you see what I'm saying?
But I do, and maybe these numbers change in the future, and it becomes more of a risk factor to have a first-time home buyer. But for now, I think it works out well with what's happening in the communities because of where purchase prices are laying right now, and I feel like we have to be able to put more people into homes. Now, obviously, these numbers can change. When we're putting this into place, we're going to find out how they're actually performing when we're putting these into place. And we're going to find out, it's going to take some time. But it's no different from somebody that, has owned a home before. It's just that they haven't had the experience of paying these amounts. So yeah, it could happen. But what I'd like to argue that with is a lot of times our first-time home buyers are new to the workforce. They tend to get more raises along the way.
Sure.
They
grow faster.
They grow faster because they're newer in the industries. They're coming in at entry-level positions. We'll just have to see how that works out. But I'm hoping we can keep this because this could make a big difference. Yeah.
All right. Well, Justin, good job. We've been doing this for a couple of years now, and I feel like I actually learned something from you. Well, if you are a first-time home buyer or a listener or viewer that wants to learn more about how to build wealth in real estate and how to qualify for a mortgage and more importantly, have concerns about your risk factor or student loans or medical bills and so forth, I want to encourage you to text the word FANNIE to 623 AZ RECON. That's FANNIE to 623 AZ RECON.